much, Scott. I appreciate that nice introduction. I don't know if anyone had the opportunity to see an article in this past Saturday's Wall Street Journal. It's kind of buried here on the front page. It says, "Profit as we knew it could be lost with new accounting statements." Now, I hate the media, the way the media treats a big idea, but they manage to do it every single time. This is truly a breakthrough thing that's happening, and if it happens the way I hope it will happen, it's going to impact every single person in this room in a significant way. Back in January, I met with the Financial Accounting Standards Board with a group of very sophisticated and knowledgeable people on my team. We had Professor Donald Sexton from Columbia University, and we had a CFO, formal CFO from a major Silicon Valley firm. We had a managing director from an accounting firm in New York. And on my panel that made this introduction to what we call fair value accounting to the Financial Accounting Standards Board. This initiative that they have been working on is the first time in about 50 years that they are really thinking about how value is created in a company. It's remarkable. We're really at a tipping point here because this problem that we have always had between marketing and the CFO of the company, and this inability to understand value of marketing is finally at a point where we might be able to overcome it. And if the initiatives that we have been working on with FASB actually go through, it's going to be remarkable and will truly make a difference in your lives. I'm going to have about 4 sections in this presentation. One, the first couple of slides, about 9 slides, I'm going to deal with the problem itself. How did the problem happen, and what are the obstacles to really understanding it? 2, I'm going to be talking about the solution. 3, I'm going to look at the revenue side of the equation. And 4, I'm going to look at the stock side of the equation. And as we go through this, think about your questions and feel free to ask questions at the end. I also have a Harvard Business Review article that came out in the March issue that I'd be happy to send anyone electronically. It's called Hidden Wealth in B2B Brands. And it addresses this specific issue. And I heard it mentioned a couple of times today about how to value B2B brands. This addresses it quite specifically. Also, if you've not purchased my Best of Branding book, I would be happy to send you one. If you'd like to purchase it, that's perfectly fine too. Just give me a card if you're interested in those 2 things, and I will get them to you. So here's the culprit, John Wanamaker. And we all know that the statement, every branding conference you hear about this statement, half the money I spend on advertising is wasted, the trouble is I don't know which half. The problem is John Wanamaker was wrong. Both halves of the communications have an impact on the brand. Part of it is impacting the revenue side of the equation, and the other half is impacting the overall brand image of the corporate brand in the company. And we've been studying this phenomenon for 16 years. I didn't set out to do this. It actually was a project that was thrust on me. We've always been involved in the area of brand strategy, developing brand strategies for major corporations. But it was a study that we were approached by GE. Richard Costello, who was the head of corporate communications at GE, asked me, he said, "Jim," he said, "I know you're passionate about the value of branding." He said, "But I can't take your passion into Jack Welch and ask for a budget." He said, "That doesn't work. He said, but help me figure this out. Let's work together to figure out how value is created. Because we know when we do an advertising campaign that it impacts the stock price. And the Wall Street Journal even has a phrase, they call it the happy coincidence. When you run a campaign in the Journal, the stock price goes up. Happy coincidence. That's not a happy coincidence. That's brand building in the most basic way. And so what we've tried to do over this period of time is to develop a systematic way to be able to look at this, analyze it, think about it, report on it, and we're making headway. We're making very important headway with CEOs and CFOs of major corporations. And once we get them, then all companies will fall under this new system. Now, CFOs have always demanded return on investment. The problem is they have never given us a mechanism to make it make sense. That we don't have, as communicators, we know that branding works. We know that when you run an advertising campaign, that it has an impact. We know that it will generate increased familiarity and favorability toward your brands. We know that it will increase sales revenue. But there has never been a reporting system that the CFO can accept. And we tried to figure out why is that? And we drilled down and found that it's not the CFO, it's the accounting is the problem. Accounting does not allow for brands to create value. So as a result, the CFO becomes the enemy of branding. And they become, instead of being an ally, which we try to make them an ally of your company, they become your biggest enemy. And they're always cutting budgets. So campaigns tend to go underfunded without some sort of a direct connection to return on investment. So what we try to do is as I said, make the CFO an ally of brand building rather than the enemy. So one of the things we're trying to do is help educate the CFOs to understand that the current accounting standards are insufficient. Current accounting standards have not kept pace with the rise of intangible assets in terms of how they build value in the company. And right now, the only way to really get that value is to sell the company. And so a few of my competitors have figured out a system that if you sell the company, here's the value of that day. But that's not the way we really work with brands. When you're working with a brand, you're really trying to create value day after day and grow it over time. That's the way to build brands. So we've developed a different system for that, and selling the company is just not a very good way to do it. So we think it's very important that internal management really should advocate and support managing their intangible assets on what we call a fair value basis. And fair value is something your CFOs understand, but they're not likely to support just yet until it becomes the rule of the land, and that's why we're working so hard to get FASB to support this concept. Accounting is using a flawed system. Return on investment, return on assets, return on equity, all of these are seriously flawed since the value of the firm's intangible assets are not accounted for on a fair value basis. Intangibles such as reputation can be managed like other business assets. Marketing communications is definitely an investment, it's not an expense. And CFOs have always seen it as purely an expense with no value coming back to the company. So another important aspect is resource allocation decisions within the company can require a better understanding of how intangible assets create value and contribute to financial performance. And we have a case study that I'm going to take you through, a very brief case study a little bit later on Aflac and how it created revenue, return on investment on both the revenue side as well as the stock performance side. And if you really want to make a CFO crazy, which I sometimes enjoy doing. You should ask them about what they call the impairment test. And this system is flawed because it can take value away from the brand, but does not ever consider value that can be contributed to the brand. And so the fair value, or the impairment test is a flawed system. It recognizes impairment but not growth of intangible assets. Now, in Europe, the International Financial Reporting Standards, which is the equivalent of FASB, the Financial Accounting Standards Board in the US, they've done it pretty well. And it's not perfect, but it's much better than what we have. IFRS defines an intangible asset as a non-monetary asset without physical substance. It has 3 key attributes. It's identifiable and needs to be separated and separable from the company. It has economic benefits that will yield future economic return. And it can be controlled. You have some control over it. So at the very least, we're aiming to have FASB adopt these standards, but we're aiming much higher than this. So what did we do that we have some answers to all of this? This started, first we have a quantitative and consistent approach to understanding, growing, and valuing brands. We have a system called the Corporate Branding Index that tracks 1,200 companies across 47 industries. This is a benchmark tracking system that started in 1990. It's been absolutely consistent over time. And we measure familiarity among a business audience in the US. Now, so it's not all things to all people. It's not global, it's not consumer, it's a business audience. And why do we choose a business audience? Because these are people like us in this room that care about brands. They have a passion about brands, they're interested in brands, and they're going to have an opinion about brands. And this does not replace traditional market research at all, but it's complementary. It works with your other types of research, and in order to be able to help you understand the value of branding. So we do 12,000 telephone surveys a year. We measure familiarity, and we also measure 3 attributes of favorability: overall reputation, perception of management, and investment potential. We also have the financial data on these companies, as well as how much they spend on communications. And what we have learned over time is that everything a company says and does impacts brand image. And in turn, the brand has an impact on the financial performance. We know that the brand experience is much better and much more enhanced when you align the business processes and the culture and behavior with communications. So companies that just throw money into communications do not have the benefit of companies that really think it out. Again, this is common sense, but we have quantified that. We also know that creating alignment between these things is very important. It's not just about improving business processes. It's not just about culture. And it's not just about communications. It's creating alignment between those to make sure that you're getting the maximum impact for your brand building efforts. And we know that it has 2 financial impacts. If you do it right, it builds brand image, familiarity and favorability toward the brand. And that creates brand power. Then there are 2 ways to measure it. One is the traditional way of thinking about building a brand, the product branding side or the revenue side of the equation, which is the top arrow. So you'll improve your sales, earnings, and cash flow, and ultimately impact your stock price through those factors. But what we also found in doing this work is there is also a direct impact between brand power and stock performance. And this becomes a consistent dashboard measure to evaluate your company, the health and vitality of your company, against all others in your industry or companies that are outside your industry. And I'll be talking more about that because that's a little bit of a different concept. I'm going to go into both sides of this equation. I'm going to talk about both the revenue side and the stock side. Yeah, I'll just leave it at that. So if you evaluate one side without the other, you're only getting half the brand value story. To look at the revenue side, which is the left side, it requires a market share analysis, a business analysis. You project market share at different levels of spending. You have a discounted cash flow analysis resulting from change of market share. And then you can report the ROI based on improving market share. On the corporate branding side, you need to have the consistent quantitative research over time. You need to model against your industry peers as well as the stock market. You can project return on investment based on different levels of spending and the potential impact that would have on your market cap. And then you evaluate return on investment performance based on improving equity and value. So these are the two equations, and I'm going to go into these two in more detail. The first one we'll look at is the revenue side. First, we have a two-part model. The market share model is statistical analysis of the different financial data and advertising media spending and image data used to improve your market share. And then there's a discounted cash flow analysis. So you're investing and then you're evaluating the return for that investment. This is it in a graphic form. So you see that dotted line there. Everything above the dotted line is the market share model. Everything below the dotted line is the cash flow analysis side. So basically what you're deciding here is the return on investment that I'm making for brand building really worth the effort? The beauty of this particular model is you can do it on a very large scale. You can do it across the corporation. You can do it by division. You can do it by product. You can do it by geography. So you can really drill down and apply this in any specific way. The negative side of this, it requires a lot of research. It requires research with your customers. It requires research over time. It really requires a commitment in terms of how you want to build your brand. If you're looking to build a brand over a long period of time, this is a great model to do that. We also then take, it's a little difficult to see, but we take a base case scenario, the current advertising spending or communication spending, and we look at different levels of spending if your competitors, depending on how your competitors respond to your campaign. So if you're launching a new product and you come out with a new campaign, are your competitors likely to be aggressive or not in responding to that? So we're able to project out different levels of spending. And this is the actual return based on a 75% competitive response rate for this particular company. They increased their advertising investment from 3.5 to 6 million. Their market share increased from 10.9 to 11.5%. Their sales revenue increased from 775 million to 1.1 billion. So they had a net discounted cash flow increase of 29 million for a $2.5 million annual advertising increase. They had over $11.50, 68 cents back for every dollar invested. So that's the revenue side. Now we'll take a look at the stock side. Again, this is just a repeat of an earlier slide. These are 1,200 companies, 47 industries, familiarity, favorability scores, consistent research over time. It's all there. It's all complete. Another important thing about our Corporate Branding Index is that it is a horizontal study. There are other studies that are out, like Fortune magazine in their most admired issue. What they do is they go out to vertical industries like the automotive industry and ask everyone in that industry how they feel about those companies. Well, the problem with that is if you're the biggest company, you have a significant advantage. If you get your troops rallied, you have a significant advantage. So what we've done is created a horizontal study, and we're not asking people about their industry. We're asking people to judge outside their industry. So that when you look at these 1,200 companies, you can compare General Motors with Cisco Systems, with any other, with Apple, and if those are the companies that are of interest to you. And so it's a very apples to apples comparison across these 1,200 companies. They also happen to be great consumers. Now, on this side of the equation, most financial analysts can explain about 80% of what drives stock performance. And that leaves about 20% unexplained. Now, with our regression models, with all the data that we have been able to look at this data over time and really drill down into what is it that drives that financial performance. Now, it changes industry by industry, but across the 1,200 companies that we track, about 30% of what drives stock performance is cash flow, earnings, and dividends. 20% is expected cash flow. Stock momentum. A stock going in a direction tends to continue in that direction unless there's something that stops it. And that can be good on the upside or it can be bad on the downside. Also, underlying financial strength is important and company size is very important. But that still leaves that 20% unexplained. And Wall Street has been pretty happy to ignore that. They're happy that they get the 80%. But what we have learned is that a portion of that unexplained can be explained by the corporate brand. And we have drilled into that. And keep in mind, what I'm about to show you changes industry by industry. Okay? Every industry is different. The dynamics are different. We understand those dynamics. We track these 47 different industries and the dynamics of each industry. So when we talk to you about your particular company or your industry, we have consistent data over time. We can identify contractions and growth periods over a 16-year period. So one of the neat things about this is you don't have to launch market research to get the information. It's already there. Now, this is just a sampling. It's 7 industries across the 47 that we track. And I picked a couple here, like the electric utilities industry is not very driven by brand very much. It's on average in that industry, it's about 1.62%. You move up the ladder a little bit, the insurance industry is 4.9%. You're getting a little closer to the consumer. Computers and peripherals, even higher, 8.49%. Beverages, restaurants, toiletries, the closer you get to the consumer, the larger it gets. And so these are the average scores across these industries. But the green represents the range of scores within an industry. So if you're in the electric utilities industry, and you're getting 0 for your brand, you realize suddenly that you can get as much as 4% of your brand, of your market cap being contributed by your brand. So suddenly it changes the dynamic. It changes the discussion that you're having with your CEO and CFO. Instead of creating an emotional argument about why we should be doing communications and marketing and branding and advertising, you're going in there and saying, this is where we stack up against our peers, and this is what could happen if we concentrate on this and build an argument and over time work toward these goals. So if you're getting nothing for your brand in the electric utilities industry, and you only would aim to achieve the average, that's still over 1.5% of additional market cap that you can get through brand building. Most CFOs and CEOs would kill for that. It doesn't look like much from our perspective as marketers and communicators, but it's huge. And oftentimes worth hundreds of millions of dollars, even billions of dollars of value for a relatively small investment. The larger you go, of course, it gets higher. Now, looking at this over time, I took two points in time. Fourth quarter 2003, fourth quarter 2006, just to show you the dynamics of the changing dynamics of industries. You have the electric utilities industry. Back in 2003, it was below 1% on average. It grew 0.69%. That is huge growth of something that most electric utility CEOs are not even aware of that's happening, the dynamic that's happening inside their industry. It all doesn't go up. You take the restaurant industry, it actually went down from 2003 to 2006. In the toiletries industry, it increased over 2%. So there's dynamics of change. If you're in the toiletries industry and suddenly you've got momentum behind you, and there's a market shift toward your organization, your sector of the business world, that market cap is suddenly more important, I mean, that is really dramatic. And you owe it to your senior management to help them understand this dynamic so that they get full advantage of it at the appropriate time. And this is the dollar value of change in these organizations. The electric utilities industry tripled in value over that 3-year period. So it went from 60 million to 180 million. The home industry grew at a very important time from 20 million to 140 million, an increase 7-fold. The beverage industry went up $5 billion, from nearly $5.5 billion. So the value here is tremendous. When we first started this back in 1990, the first year we, on average across the 1,200 companies, was 5%. Now it's 8.5%, fourth quarter 2006. This is the change across all the 1,200 companies. So you have fourth quarter 2003, 7.78, and fourth quarter 2006, 8.45 on average across the 1,200 companies. As I said, in 1990 it was 5%. So that change is 0.67%. You're getting that on average. The companies are getting that for not even managing it. It's just happening because brand is becoming more important. The dollar value of that across, on average, across these 1,200 companies was over $1 billion. And I'm sure that most of you are not telling this to your senior management, that the value that they're getting as a result of this. So it's very important to understand these dynamics. So if we recognize that there's value to brand building, how do you really leverage that? What do you do? I mean, what really drives the brand value? Well, again, using our quantitative research over time, we know that advertising, as much bad press as that gets, and we know it gets a lot of bad press, advertising is still a heck of a great thing. About 30% of communications spending, or it has a 30% impact on brand. Other factors are public relations, investor relations, employee relations, etc. Corporate size is also very important, and there are also secondary factors, such as how good is your CEO and CFO at communicating, for example, to the investor relations community. We can take that information about your company and we create again, a base case scenario. This is very similar to the other one where we were looking at spending into the future. We take the current reported spending, and on the x-axis we look at different levels of spending. What would happen if we spend more? What would happen if we spend less? And we identify the point of diminishing returns, and we present this to your senior management, your CEO and CFO, and say, you know, it's not necessary that we would recommend that point of diminishing returns as the ultimate budget, but it changes the dynamic of the conversation. You're no longer talking about asking for budgets based on an emotional pitch. You're basing it on the value of the brand that you can bring to the table. We also, every CFO in the world wants to know what would happen if we spend less. And we show them. And we have never had a CFO suggest that we should spend less when we present this. They're always pushing. In fact, most cases, they're pushing the communicators to increase their budgets in this kind of a scenario. This is an actual case. Again, it's hard to see this a little bit, but this is an actual case of a company that had a percentage of market cap added by brand equity of 8.1. This is in a commodity industry. It's the second line up from the bottom. And if you look at the top line, which is the stock performance over time, you can see it's very hard to identify when value is really being created. You can see that the stock is going up, it's going down, it's going up, it's going down. But that percentage of market added by brand equity is the key number here. And this was a very modest campaign designed to improve the image of the organization. And it was launched over a period of a year. The campaign came out, and immediately they had that happy coincidence. The stock went from 44 to 58. The CEO was thrilled. He said, "I don't see any reason to keep spending money on this as we accomplished our goal." It went up. And we said, "You really didn't accomplish the goal. You created a short-term boost in your stock price, but what we're trying to do is build the fundamentals of your stock and really improve the value over time. And we know that you can do better than this," and we identified 8.9% as the goal. They stuck with the campaign. It reached 8.9%. And the return on investment, they had over a $4 billion increase of market cap. There was 0.8% of increase in brand equity. Out of that, there was $464 million of newly created brand equity value. Now, we could have easily taken full credit for that, except that's not the way we work. The fact is their whole industry was in favor at that time. And so the whole industry improved, and we were able to identify how much the industry improved and how much value we got more than the industry. So the industry accounted for $342 million. We got $122 million more than the industry, and we got a $5 return for every dollar invested. That was a $24 million ad campaign, or it was really a communications campaign. So I'll do a quick case study here on Aflac. Having data over time, we're able to identify historic trends. And as you can see, the blue line here, the blue chart, is familiarity. The red is favorability. And that green line across is advertising investment. Now, I keep saying advertising investment. Our point of view on that is that advertising, if you have a larger advertising budget, the chances are you have larger communications budgets, you have larger public relations, all your communications budgets are larger. Advertising is the single most measurable form of advertising investment, so we look at that, and that's how we measure it. But we see this increase from 2002 to 2003, this significant increase, you also see the improvements of familiarity and favorability over that time. And they really jumped. Their revenue, their premium income also jumped at that time. So they were, but it was kind of in parallel with how much they spent on their communications programs. Now, what I find fascinating is this chart, and I hope it shows up for you. The blue line is overall reputation, the red line is perception of management, and the green line is investment potential. In the background are dotted lines, and they really don't, unfortunately, they don't show up well at all. But the point of this slide is that they went from, Aflac went from the absolute back of the pack in terms of their category, their peer group, to the absolute leaders of their category over an 8-year period. And it didn't happen overnight. They had to be consistently communicating over time. And communicating over time got them to about the middle of the pack, but that real surge, that increase in communications happened in 2002 to 2003, and that's when they really became the leaders of their industry. Also looking at from 2002 to 2005, you can see that the industry average was 4.81% in 2002. In 2005, it went to 4.9%. The value increased significantly because the industry was doing better. But AFLAC increased from 6.42% to 10.60%, and they increased from under $1 billion to $2.5 billion. So that was a real significant increase. And so they got about $8 back for every dollar invested over that 3-year period for a $196 million investment. So in closing, some of the benefits of fair value accounting are quite clear. Companies need this kind of information to make better decisions. This data and the analytics around measuring value and helping them understand the impact that it has on market cap creates a closer working relationship between finance, marketing, and HR. Investments in value creation will be accountable. That's another major benefit. Real drivers of value will be measured, valued, and reported on. And the stock prices will more accurately reflect the value being created by the company. So these are some of the benefits. It just makes sense is the other benefit. You know, it's just good business to do this. These are some of the books that I've written. As I said, if you do not have a copy, I'm happy to get you a copy of the Best of Branding. I'm also, you can give me your card or send me an email. And also the Harvard Business Review article, I'm happy to email that to anyone who is interested. Someone had requested a copy of these slides. I generally don't give these out, but I'd be happy to provide some sort of a version of that if you're really interested in it. Scott, do I have time for questions?
Yeah, I think we can take a couple questions, and then we're going to go straight to the panel. Any questions?
Is there a way to learn sort of how to actually do what you did here, or we have to hire a firm to do that?
You have to hire us. We've worked really hard on this. I've invested my own money into this, building this over time. We've invested in times when it was really difficult to invest in economic downturns. We never gave up on this. We continued to build it. And so we'd like to reap the benefits of that. We think all 1,200 companies who are in our index should be using our data. Companies that are not in the index, by the way, the same concepts hold true whether you're a public company or not. You should always be valuing your brand, your corporate brand, and the value that it creates. That being said, I mean, yeah, it can be done. We're sharing our data with a number of universities. Santa Clara University is using our data right now and analyzing it and confirming some of the findings that we have found. So we're not stingy about it, but we're careful about it. So, you know, we got to be reasonable. You know, we're reasonable people. We're interested. We really want to make this a standard for measuring that impact on market cap because it's there. The data is there. There was a question over here. Yes.
Do you list the companies in that 12 companies that you
The 1,200 companies are in rank order on our website, and also alphabetical order in our website. So if you'd like to visit that, the website is CoreBrand.com. Yep.
I have a second question. If a company I'm looking at is not in your database, what is the methodology for assessing the value of a brand that's not in your database?
Yes. We can calibrate them to the model and relatively quickly. It doesn't take us long to do that, and it doesn't have to be a tremendously expensive process. So, we're able to do that. And to give you some sense. If it's a public company, it's a little bit easier than if it's a private company, but we can do it as a private company as well.
You would need data from the private company, I'm assuming?
Some data, not a lot. Yes?
How many companies are using this now? I mean, has it been rolled out and have pretty good uptake? And what's the average cost to do something like this? I mean, ballpark, I know that
No, it's, we provide our data to over 100 companies on a quarterly basis. So I would love, as I said, for all 1,200 to use it, but I'm quite happy with that 100 use it. And the cost ranges from $15,000 for the very basics to about $105,000. That's just for the first study, and after that, it gets very inexpensive. One of the really important things I'd like to get you to think about is that it's really important to provide your senior management a quarterly report. Don't do it once a year, don't do it every 3 years, because then when you have that valuable time with your senior management, you are only talking about methodology the entire time rather than the results. If you do it on a quarterly basis, they remember the method that you used, and you can talk about the results, and you're having much better quality time with them. So we recommend doing this on a quarterly basis. Yes?
I don't want to get into a rabbit hole, but just simply spending money on advertising and then using that as a part of the equation, and you have this outcome. Probably not helpful.
It's not the whole picture, absolutely not.
Talking the advertising back to the quality branding that will help us deal with this
No question about it. And we have a method for evaluating the quality of the communications programs. Our base report is based on a one-times multiplier. That, in other words, it's assuming that your advertising and communications programs are at least equal to what they were in the past. However, if you can improve it by 25%, then we have a way of measuring that and showing how the impact that would have. We mention it, but we don't go into detail on it. Is that it, Scott?
Yeah.
Okay.
Take one more question.
Any other questions?
Any other questions?
One back there.
Could you talk a little bit about validation of this? It seems like there's a lot of consulting companies or whatever else holding their models like this.
I know of no other company that has a model like this. There are organizations that are a lot larger than us that get a lot of publicity. We go toe-to-toe with them every single day. We're happy to talk to you in detail about that. I have presentations comparing our method to others. And validation, it's been validated by CEOs, CFOs, professors from various universities around the country. More importantly, it works, and that's how we validate it every day. Thank you very much for your time.